Pramod Gubbi, Managing Director and Head of Institutional Equities at Ambit, joins us right now on the show. Pramod, always good having you. Thanks so much for taking the time out and speaking to us at Bloomberg Quint. It's about 24 days of April. We barely scratched the surface of earnings, if I can call it that. But we're almost getting there. A few heavyweights, a few interesting mid-caps. What have you made of the earnings season so far?
Early days, but as always, the beginning of the earnings season is led by good quality companies, and they deliver almost on a consistent basis. So it's too early to make out the trends, but the expectation is that this quarter will be certainly better than the last quarter, and even on a year-on-year basis, we are clearly on an upward trajectory as far as earnings growth is concerned. It's a different matter in terms of whether it will be in line with expectations, because as ever, expectations from the market is quite high. Again, I think we're looking at somewhere between 15 to 20% earnings growth yet again this year. We've seen the same situation over the last 4 years, only to end up somewhere in the mid-single digit or perhaps lesser. So we reckon that it's more important to look at vis-a-vis expectations. Earnings growth are in line or not, but it'll certainly be on an upward trajectory as far as the trend is concerned.
Pramod, we have seen the rupee weaken against the US dollar over the past few days. Should we see further weakening of the Indian rupee? What themes would you like to perhaps focus on and then eventually play on going in?
I mean, the rupee is certainly weakened already against most other currencies. It's the weakness in the dollar which clearly has meant that it doesn't show up, because most of us look at the dollar rupee number. That's begun to correct with the yields back up to the 2.9 or near the 3% range in the US Treasuries, and that's given strength to the dollar, which should have been the expectations in the first place, except for concerns around trade wars and so on. Now that's less of a concern. I guess we're back to that expected trajectory of a strengthening dollar, which isn't particularly great, not just for the rupee but emerging markets, equities in general. So to that extent, emerging markets as an asset class might take a bit of a breather. But within that, we've talked about IT as a theme for the last 12 months. It's clearly played out very well, and it's also coinciding with both the macro and the micro lining up quite nicely. The macro in the form of US economy doing well, US earnings doing well, and with the tax cuts to boot, there is enough firepower amongst US corporates to increase their IT spends. And at the micro level, I think the last 3-4 years of investments that the Indian IT companies have made in terms of digital and so on is beginning to bear fruit, as we see in the commentary from the likes of TCS and Infosys, and add to it a tailwind on the rupee in the form of rupee depreciation. I think that's a nice way to play this whole theme.
Mm-hmm. Okay, Pramod. So one was this IT. I mean, last week we saw the return of. If it ever went away, we saw a return of the consumer preference or the investor preference towards consumers, and of all sorts, right? Alcohol companies moved up very, very strongly. We had some of the staples doing really well. ITC was a case in point as well. The market seems to be loving to reward consumption. Is it because there is lack of other options available? Or is it because the market believes that the earnings growth out here due to GST and other factors will be so strong that what is appearing expensive right now will start looking a lot reasonable in less than 12 months out?
Yeah, I think it's a combination of both. Certainly the spending ahead of the elections, both in terms of election spending itself and also the rural programs that the government has in place, could mean that at least consumption as a contributor to GDP growth will hold up, and also I guess it's a theme of a move towards quality. I think after the Feb-March sort of a correction, the return of the markets this time has been clearly towards quality, unlike what we saw, say, middle of last year, towards the end of last year. And once you shift focus to quality, you will end up in sectors like consumption, which tends to have a larger number of good quality companies. So a combination of the type of companies and the macro which is supporting investment in consumer. Yes, valuations are not particularly attractive, and even if you assume a fairly strong earnings growth, I don't think it is easy to justify those sort of multiples. I think what underpins these sort of multiples of valuations is the longevity of this growth. I don't think anybody would argue, given a billion plus people, consumption will be here to stay, and to that extent, you are trying to factor in not just high growth, but also prolonged high growth for many of these consumer companies, and that's perhaps the way the market justifies the high multiples.
Well, at least two members of the MPC, that's the Monetary Policy Committee, are now indicating or showing early signs of a reverse in the interest rate trajectory. Do you think this can change the complexion of the markets going in, say, if we were to look at a price hike coming in, say, over the next couple of quarters?
I think a couple of hikes may not make much of a difference. It's just a sign of the economy recovering, and I don't think there should be an issue. And I guess the RBI will be watchful of the combination of both inflation and growth. Yes, the core inflation has been sticky, and you need to take cognizance of that. But at the same time, they need to be careful that they are not too much ahead of the curve in terms of curbing the pickup in the economy. So a couple of hikes over the next 6 to 12 months may not dent the markets nor the economy, because at the margin it's not the interest rates that are holding up the investment cycle. I think we need to watch utilizations and a more consistent recovery in consumption that'll take these utilization levels to an extent that'll drive a private capex recovery. And also, I guess, given an election year, there's the big sword of uncertainty for any private sector to commit significant capex. So in any case, we're looking at the investment cycle to pick up, post-elections. So the interest rates at the margin will not be the delimiter in my view.
There's a bit of a volatile time out there for investors in the commodity space. In fact, up next we also have Sheshagri Rao of JSW Steel speak about a bunch of things. But Pramod, my final question to you would be about how to approach this pocket. We've had two very strong calendar years for base metals and, well, actually even for all kinds of commodity names. Are we reaching a bit of a peak? And is this news flow just an indication of the volatility which comes ahead of when sectors or themes or trends reach a peak of sorts?
I don't think we're at the peak yet. I think there are more legs to this story. You have to take a view on where global growth is heading. Nothing that has been suggested in terms of data points over the last 3 months suggests that global growth is peaking out. So perhaps we have another 12 to 18 months before we see that. And clearly commodities are a direct play on that sustained or concerted rise in the global economy. Volatility has always been part of the commodities game, and that's likely to stay, especially in a year when liquidity will be a big factor as the Fed especially does its roll off of U.S. Treasuries, moving up from, I guess, we're somewhere between 15 to 20 billion a month now to 50 billion a month by October, and that could potentially increase post that. And also the behavior of the ECB, which is in a bit of a dilemma in terms of whether to sustain the program or not. So such bouts of liquidity will always be a key factor in the commodities market. But more fundamentally, I think global growth has enough legs to sustain this commodity rally, at least for the next 12 months.
And so my question to you, Pramod, then would be that there are people who would have identified the trend, good for them, and invested in this commodity space maybe a year and a half before, and are sitting pretty. The question mark is only for people who want to invest afresh. For your clients who are asking you about whether or not to make fresh investments into the Indian metal companies, what is your advice? I mean, are you finding better opportunities and therefore telling them not to, or is that a good enough part of your portfolio allocation that you're comfortable telling them to buy even at these levels?
Yeah, certainly. I think any portfolio should have an exposure to the metal space, at least from a one-year perspective. Of course, you need to be clear. This is a cyclical sector. The drawdowns can be quite meaningful, especially if the liquidity goes out of the market. But having said that, like I said, in a situation where global growth is quite ubiquitous, you can't afford not to have any exposure to metals. Timing is the hardest bit in our profession, but to the extent that you have visibility of global growth sustaining for at least another 12 to 18 months, I would suggest even now having some exposure to the metal space.
Okay, Pramod, my last question is, we've asked you enough sectors from our end. What is, to your mind, the best bet over the next 12 months in terms of a theme or a space or a clutch of spaces? Also keeping in mind that, almost everybody that I speak to speaks of a possibility of a very big drawdown being round the corner. The conversation was on even when we were at 9,800 or 9,900. Since then, we've had a good rally, but those conversations haven't died down as yet.
Yeah, look, there are plenty of possibilities or possible catalysts for another correction which will take us back to those levels or perhaps even lower. Right from geopolitical to oil prices to liquidity from central banks, you can go on. So to that extent, volatility is here to stay. There will be opportunities to get in, when the markets correct beyond its reasonable sense. But one perhaps theme to look for over the next 12 months is private sector financials. Again, it has been a theme for the last perhaps 7-8 years now, but increasingly at a time when cost of money is likely to go up, not just globally but even locally. We are seeing bond yields picking up. Private sector banks with a very strong CASA franchise will suddenly become increasingly competitive and start taking market share. So that can underpin its loan book growth and margin expansion, whichever way the bank chooses to position itself. And that can deliver disproportionate earnings growth over the next 12 to 18 months as we move towards the tightening cycle. So to that extent, that's one sector perhaps worth watching out.
Okay, we'll do that. Pramod Gubbi, always a pleasure having you. Thank you so much for taking the time out and speaking with us today on Bloomberg Quint.